All right, ladies and gentlemen, I hope you had a wonderful weekend and happy Mother's Day to all the moms out there. We got a big week ahead of us with the CPI data, and after last week, what happens this week is going to determine, do we hit a new all-time high or do we get back to that volatility? So, Chad, we got a lot to talk about. I got a recap of the week. I have a couple of plays. I have a couple of questions and a mini lesson here on the Fed, but all in all, we got to get ready for this week. And last week, it was quiet. It was calm. There was some earnings. You don't get much of that this week, but now, after last week was so chill, we should get a lot of craziness. So what I need from you, a thumbs up on the video. Make sure you're subscribed. And if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/the stock market. We will see you there in the morning, baby. Run it.
Working to the couch, it's the 2020 election. Live in the hills, but I still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then it feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Finger to the down.
And I almost forgot, today is Sunday, tomorrow is Monday. This is the random account generator, and I need your help. I need you to post a random option trade, put it in the comments, keep it below $100, preferably with time, and tomorrow morning we are going to pick a random play. But like low-key, ever since I got the chart of the account and have been showing you, y'all have been hitting it, baby. So let's go. We got a bros from last week that we got to sell out on, but Chad, you have been doing good, so let's get it. But now, right to the keys, man, or actually I'm going to start here with the chart. Obviously, you got to pay attention to where we are at on the market because this is a big deal. And then the other factor that you have to look at, it's going to be the handy-dandy bonds. So this is actually the first key you'll see when I get into it. But ironically enough, coming into this big week with data, we are chilling right there at 4.5 on the 10-year. And that has gotten a lot of attention over the last couple of weeks. So you have your big data, you have your big level. It's either 52, 5,300 on the SPX or 4.5 on the bonds. We're either going to find out a lot higher or a lot lower depending on what the data says. So beyond just what happens with inflation, we are looking for a reaction on the bonds and ultimately what it does to equities. Now, the ironic part about this, if you've seen a lot of the news lately in regards to CPI and inflation, everybody has been saying it's going back up. Well, coming into this CPI on Wednesday, people are thinking that it's going to come in by 0.1 lower year over year, month over month. Right now, analysts are expecting a slightly lower print. Now, by the time we get to Wednesday, maybe even by the end of tomorrow, that may change if the attitude starts shifting. But for now, this is definitely a little less volatile than the other data sets we came into. Remember the non-farm just a couple of weeks ago, the estimates started out low, then the market got volatile, and by that data set, you had the estimates up like 50%, and then it ended up coming lower, and that created a big surprise because everybody freaked out ahead of it. So coming into CPI on Wednesday, people are not freaking out just yet. So we'll see how it all plays out. That is key number one. Now, key number two, beyond the CPI, tomorrow, we're not going to be getting much. You will be getting a little bit of data from other countries, but the real action is going to start on Tuesday. I thought the PPI or the CPI was Tuesday, but it's actually PPI on Tuesday. Producer prices, that has the ability to move bonds a lot, and it has already over the last year or so. So we're going to watch out for that. And then you have a Powell speech at 10 a.m. Eastern time on Tuesday. I don't know the contents of it, if it's going to be related to monetary policy, but he's probably going to attract a lot of eyes there, and people will definitely be searching for that. But beyond that, there will be a couple of earnings. We did get to wrap up a lot over the last couple of weeks. I think some of the smaller names, you will be getting NVIDIA. That'll be like the final cherry on top, and you'll still get random reports throughout. But moving into this summer now, I really think it's going to be all about the macro data. We're going to keep getting data sets week after week, and before we know it, we will be right at June. That's where everybody thought things were going to happen, and at the very least, we will be getting a SEP from the Fed. So that is key number two. The final thing, we're going to talk about it a little bit, but watch out for some of the liquidity. We brought this up last week with some of the moves, and why I'm bringing this up now, because this week should have a lot of activity. There shouldn't be that many holidays. Everybody should be back, and if that's going to be the case, hopefully we could see that liquidity return. But if we don't, that will definitely leave you, or I would at least be a little bit concerned. So watch out for that. The only other thing is keep an eye on the other central banks. I think we will be hearing from the Swiss National Bank and a couple of others, and the whole point of all of it is just watch if you get any more of these subtle moves. Last week, we heard from Brazil, the UK, and the EU. They even gave some plans, but it had a really big effect on gold. And if we see some of that this week, yeah, our CPI and everything will be important. But if some of these other countries start making some of those moves, showing their independence, then that could be a very big deal. And I do think that'll end up playing out on gold. So those are the keys. It should be a very fun week. We'll get the data, see where it takes us. But now, let us get into the plays. So, right off the bat, I have a couple of plays this week. I did bring up last week how if we do kind of get lower liquidity, we should find out by Tuesday after the data if people are really trying to trade here. But there will be a couple of plays that are good for swings like Airbnb and Roblox. But if the liquidity is low, we will have to take our time and slow it down. So keep that in mind. But as far as play number one, I'm going to be watching out for gold. I think we missed it on Thursday. We had that live watch list. That was right after the Brazil stuff and all of that. We talked about it, and then literally it shot up 1.5% by the time we woke up. So it was a huge move on gold. If it does come back to these like 2300s, I will look to make a flip to the upside. I will not be shorting it this time around. And then if you do hear from another central bank or they give real concrete guidance, I do think that will be able to move gold a lot. So watch out for that. That is play number one. Then play number two. I made this play on Friday, but the likes, and honestly, I think we're going to have to change it up with the likes, man. So some of you may like it or may not, but point is, I did make a play on Friday, and I grabbed VANI. I made the average down. I am concerned, if you've watched the other videos, about that shelf offering and all of that. If you really don't know about VANI, they're the ones a couple of months ago they tested on rats for an obesity drug, and they had very promising results. That's why we got into it, got free shares, then we played, then got clapped on the second play, and then finally I made my average down. So I think I grabbed like 4,400 shares. My average is around like $2.20 now, but the thing about this, in a weird way, we have data on Friday, and if this doesn't play out as magically as I think it will, I am prepared to hold this play for a year. And that may sound surprising, but why I say that, because I have brought up VKTX. They were another one of these early drug companies that came up with good trials, and then before you know it, they had an obesity drug, and then their earnings are good, and everyone's talking about buying them out and all that. Well, they had a very similar setup, and we watched it earlier, and I was worried about that offering thing, but the first time VKTX started getting traction in this space, they did the exact same thing. The problem was they would have pops, they would come down, and then like every 3-6 months, it would go up like 50, 100%, but there was big drops, and it doesn't necessarily mean that good data and this offering will make it go up right away. And all I'm trying to say is it took VKTX about a year. If that's kind of what we're hoping for, I am keeping a larger time frame in mind. So I did make my average. It was lower than I thought I would put into it because it was very hard to get filled, but I'm kind of cool with the amount that I'm holding in it for now. But that is play number 2. Watch out for that. Then finally, play number 3. This one really caught my attention on Friday. I want to see how it plays this week, especially with the data. But Tesla, a lot has happened since their earnings, and I think it's very hard to tell what people are reacting to, because I remember on Friday, people are like, oh, it came back below earnings. And I was like, well, no, I don't think it did, because this little pop, you remember, that was that China news with the whole Baidu and the full self-driving in China and all that stuff. This was the earnings. So I'm like, wow, this is almost like a $60 range just in the last like 20 or so days. So it could be massive depending on how this week plays out. If they have any news, I would watch out for China. I think right now China stocks are underperforming America the worst in 50 years, but they've been trying to get back on it. They have all these headlines. Remember last week, it was kind of the third week of rally, so we'll see where this plays out. But China news could play out in China news could play out, domestic news, and then anything just related to the broader sentiment and the data. So watch out for that. No plays on Tesla, but that is play number 3. And now as far as everything else, plays from Friday, I didn't really do much. And we were talking about slowing it down a little bit. And what I meant by that was like, hey, just if liquidity's low, like I like Airbnb. That's a play I think I'm going to be making flips on with shares, but it could take another week or so if the volume is going to stay low, if we're kind of playing this weird summer move. But I do think if you could time it right with the liquidity, that's going to be the best thing in the world. But if not, then it could actually end up hurting you. So going to take it a little slower there, but I didn't make as many plays. I closed out my MO from Friday. It still had another week of time, and it got in the money, but I said, hey, I lost on the other one, so let me take some profits. We could walk away with a little bit of a win. So that was my first play, and then I lost on every single earnings play, bro. Super sad because some of them I even put a little bit more money on the pre-run-up, but, dude, this earnings season, whether it was playing the ones after, I mean, there was only a couple of hits. We got our Starbucks, we got our Tesla, but this earnings season was pretty awful, and it cost me on here. So I did lose on every single earnings play. I think there's like one or two, but in my it's a loss all the way around, man. So that was bad. And then I made the VANI average, and then other than that, we're gonna ride it into next week. I think I'll be playing a little slower. I had a couple plays come back up. I'll give you updates if I get back out of those, but it should be chill, and I think the data will provide. But now that's all I have for you, Chad. But let's get to some questions. I got a good one here today. Really, I forgot to ask you guys for a lot. I went over the watch list and even some of the questions I did write down, but a lot of you guys had questions so far on this earnings season, and why do stocks go down if earnings are good, or vice versa? Bad earnings, stock goes up, or good earnings, and then the stock gets clobbered. So here's the deal. My answer to this recently, I'm just telling you about this earnings season, it's kind of unique. Usually we at least hit a couple of them, and we did get a couple of pre-earnings, but this one was it was a massacre out there. But my answer to this lately has been liquidity. So we were just talking about you're getting the smallest moves in terms of data and guidance, and everybody tries to justify it. They're like, oh, well, yeah, no, they didn't meet the bar, it's priced in. It's like, no, dude. I'm telling you, like, even I think Airbnb, they beat every set of guidance except for like nights booked. Like, we're talking the most tertiary stuff on some of these names, and you could go down the list. I'm telling you, there was some like Starbucks who were really, really bad, but there was like names like Shopify, they did not do that bad, and it's not like they were that far from expectations, but they went down 20%. And I'm blaming liquidity. I think liquidity is low. That's why these small little catalysts and moves are causing big moves, because I just don't think there's that much real money chasing after these plays. So every transaction has a wider range of movement. There is low liquidity. So could be because of summer, and it could be because all the money is in money markets in NVIDIA and trapped in these pockets. So that's one big thing I am trying to say for this quarter, because you don't really see it this bad all across the board with our average earnings estimate going up. It's not as if S&P EPS growth did not increase at a pretty good rate. I think higher than inflation so far. So that's the big thing. But in other circumstances, most usually it is because the bar was set too high. It's either these companies move 30, 40% after their earnings and they were expected to grow 50, 60% and they only grow 30 or 40, then yeah, well, market was expecting a lot more. That's usually what it is. But I will say this earnings season, you definitely had way more exasperated moves, and I think it was because of the low liquidity. So hopefully that helps out. That was a very good question. If you have any more too, y'all let me know. But now, let me give you the last one. It wasn't a question. I thought I could just throw you guys in a lesson here because we're talking about it, and honestly, I love y'all, and I think some of y'all riding with me on this, man. I think, like, low-key, I could probably turn every single one of these watch lists into a college course, like, to the point where we could go through the book. I might even quiz you, but I'm bringing up all these concepts. You guys are literally, I love how we're feeding off of each other with the energy, and now I think we need to talk about central bank independence. So I do have another reading from you. This is going to be from the same book. This is International Political Economy by Thomas Oatley. Like I said, this was a book that I studied when I was in college, and even if you go search the book name, you'll find all of the syllabuses around all of the college campuses that still use it today, and this is the most updated version. I even have a couple of lessons we could go over that reference Trump and Biden in the recent, so that's even good. But This book is up to date, and I think you could learn a lot of macro concepts, as well as hopefully my goal would be to help you develop the balanced view, because you'll see as we go through back and forth, it is going to show you both sides and not pick a side. And I hope you guys can all learn to do that. But today, what we're going to be talking about is central bank independence. And I want you guys to understand what that means. And then I want you to have one example of a bank that is independent and then one that is not. So let's get into the reading, my friend. Commitment mechanisms. If you guys remember the time consistency problem and all of that, if you watch the other lesson, you should be up to speed, but this is going to elaborate on that here a little bit. But commitment mechanisms. Governments try to establish a credible commitment to low inflation by creating commitment mechanisms in the form of institutions that tied their hands. Two institutions have been particularly prominent in this quest for commitment mechanism: independent central banks and fixed exchange rates. In theory, both can provide a credible commitment by preventing the government from using monetary policy to achieve short-term objectives. In practice, however, only central bank independence has actually done so. Central bank independence is the degree to which the central bank can set monetary policy free from interference by the government. More specifically, central bank independence is a function of three things: the degree to which the central bank is free to decide what economic objectives to pursue, the degree to which the central bank is free to decide how to set monetary policy in pursuit of this objective, and third, the degree to which the central bank can be reversed by other branches of government. A fully independent central bank has complete freedom to decide what economic goals to pursue, the capability of determining on its own how to use those policy, and complete insulation from attempts by other branches of government to reverse its decisions. So hopefully you guys get that, and I encourage you to think here, because it did give you three criteria. I think one of them in modern times, at least in our United States case, you might be able to debate a little bit. So tell me what you think it is. That's going to be, if I had a pop quiz, that's what I put on the pop. I don't have a pop quiz. You know what I'm saying? Oh, is this it? Yeah, this is it. So moving on. This is all. I'm done after this one, though. It's a good one. But Switzerland's central bank, the Swiss National Bank, provides a good illustration of a highly independent central bank. So this is the one that is highly independent, SNB, the Swiss National Bank. Ironically, we were just talking about that. The national bank law that established the Swiss National Bank contains no provision whatsoever for allowing the government to influence monetary policy. In addition, the bank's principal policy-making body, the Bank Committee, is composed of 10 members who are selected by the Bank Council, a group of 40 individuals responsible for the management of the bank. Thus, the government has no direct role in selecting the people that make monetary policy decisions. As a consequence, the Swiss national government cannot easily influence the monetary policies adopted by the Swiss National Bank, which thus controls the Switzerland monetary policy independently of everyday vicissitudes of Swiss politics. On the other end of the spectrum lies a fully subordinate central bank. Politically subordinate central banks implement monetary policy on behalf of and in response to the government, which determines the goal of monetary policy, instructs the central bank on how to set monetary policy to achieve those goals, and can reverse the decisions if they are contrary to the ones desired by the government. So hopefully you're getting this right by now, but it's saying instead of deciding its policies and going about it, it's saying the government decides the policy of the central bank. And in this case, the Reserve Bank of Australia provides a good illustration of such a central bank. The Australian Secretary of Treasury, a government minister, has final authority over monetary policy decisions and must approve any interest rate changes that the bank proposes. In addition, one government decision-making body, the Australian government, thus has considerable control over monetary policy decisions made by the Reserve Bank. As a result, the Australian monetary policy can be strongly influenced by the government's political needs, granting the central bank independence. Actually, I should stop right there. Hopefully you get it. Highly independent example in today's modern world, Swiss National Bank. Highly non-independent, the complete opposite, is Australia. So moving on, granting the central bank independence solves the time consistency problem. Remember, this is the one related to the final. By taking monetary policy completely out of politicians' hands, monetary policy is no longer set by politicians motivated by short-run political considerations. Instead, appointed officials who cannot easily be removed from office set monetary policy, which is thus insulated from politics. Insulating monetary policy decisions from the short-term political incentives make it less likely that monetary policy will be directed toward short-term goals, such as a temporary increase in employment, and more likely that it will be oriented towards price stability. An independent central bank, therefore, can make credible commitment to low inflation, even though a government cannot. So this will probably be on my pop quiz because I would want you to think about how this relates to today. You should learn something out of all of this. And I mean, what macroeconomics is, I guess I'm giving you the answers. What it's telling us is that when it comes down to, hey, we're going to lower inflation, the only person you should believe is a central bank, and then you have to go weigh their qualities, go back to the 3 criteria, and see if they actually meet that standard of independence. But governments and their claims to lowering and all that, it doesn't really matter, believe it or not. So the central bank's commitment to low inflation should in turn affect wage bargaining because the central bank is not motivated by political objectives. Labor unions and business will believe that the central bank will deliver the inflation rate it promises to deliver. They will then negotiate next year's wage contract to embody the stated inflation target rather than their best guess on next year's inflation. As a consequence, they are more likely to establish a nominal wage that maintains the appropriate real wage. The result should be lower inflation as well as less variation in the rate of employment and growth. Granting the central bank independence should lead to lower inflation, higher economic growth, and lower unemployment over the long run. So if you don't get that last paragraph, this could even lead to one of another lesson here because we could talk about unions, but it's saying, and maybe factor this in, imagine all the surveys you get and you're like, who are these people? Who thinks inflation is going to do this or that? Well, there is big things in unions and labor groups and certain organizations, if they believe their central bank is credible and independent, they will believe them. So keep that in mind. That could be influencing even surveys and what you see today. But Chad, I hope you enjoyed that as much as I did, but that is all I have for you. Those are your economic lessons, plays, everything else. I hope you drop a random one. I hope you enjoyed the lesson, but I'll see you in the morning. And oh, no, wait, no. That is your watch list, ladies and gentlemen. Make sure you're hydrated, healthy, ready to go. Make sure you post your watch list, all that good stuff. Listen, man, pray, meditate right now. Why not, man? Happy Mother's Day, but do it, man. Give yourself that time. And y'all reached out to me. Y'all let me know it was, bro. Hey, man, I love to hear it, bro. So let's go, man. Every single day, bro. Otherwise, listen, man. I'll just save it for Philo. Or not.